Hey friends, Lucian here with the Bullish Bears team. This video is going to be about bear trap trading. I'm going to explain what a bear trap is and then show you what it looks like on a real life stock chart. So bear trap trading is when a bearish chart pattern occurs and then falsely signals a reversal of the rising price trend. So when you see a reversal pattern that is formed on an uptrend, you think that it's going to fall and continue falling down, but then it doesn't. Price could either trade sideways or then go back up. And usually when this happens, you either missed a support level or missed the overall uptrend. So you should have bought in the dip rather than shorting. And this happens a lot in trading and also on all different time frames. So I'm going to show you just an example here of the SPY. You'll see right here on a daily chart an overall uptrend right here. So price has lower or higher lows being formed. And then you can see kind of this rising wedge, and then price starts to fall out of that rising wedge. So the shorts start to look to come in over here and take bearish positions because they're seeing, oh, okay, price is falling on this wedge and it will continue, let's say, falling down right over here. But then what will happen a lot of times, again, you'll see this consolidation or the reversals, and then it ends up right here. You can see this is looking like it's going to continue to fall, and then boom, bulls come in, hold the line, and then price reverses to the upside, so it can start to trap some of these shorts. And you'll see again, price will then move up here, and it'll break kind of this area. You'll see some consolidation, or as price is starting to fall, price then moves back up again and kind of breaks this level of resistance. So it kind of catches the shorts off guard, right? And then what will happen is when we look over in this area up over in here, you'll see price, again, starts to reject this resistance level, previous high over in here, and shorts will start to take a bearish position down over in here again, right? So you'll see kind of price falling down over in here, and then price will look like it's continuing to fall, and then boom, bulls come back in and push price up again. So it's kind of catching those shorts off guard. They're trying to be bearish and have the market continue to fall. But then what happens is you'll see right here there's an overall uptrend over here. If I just remove this line and I just re-add it over in here, it's still an overall uptrend, right? So price is still continuing up, but again, a lot of times the bears will miss that it's that consolidation or those flag patterns, and it forms new support levels and continues up in the channel. So there's a term in the industry called the short squeeze, and this is where short traders get trapped, and it causes the short squeeze, meaning those traders need to cover their short positions, and then a lot of times it causes the stock to skyrocket up. And you'll see right here, here's an example of price is starting to fail right here. You have that kind of bearish candlestick, and then boom, it actually breaks out of this kind of that falling channel right here, breaks out, shorts start to cover. You'll see volume coming in and price starts to skyrocket up. So this happens all the time with all different types of stocks. So that's why it's important to learn, your candlesticks, your patterns, how those patterns work, and then learn how to draw those trend lines and find those bigger overall, rising and falling wedge patterns. Because again, if you miss them, you can think something's going to be bearish, and then it turns and it holds support at those support levels, causes those short squeezes. Shorts got to cover, and then price ends up rising again. So this is why it's very important to become a versatile trader. So if you're only a long and you don't only know how to trade long positions, it kind of limits yourself or kind of handicaps yourself when trading, because there's many a times that the market will go bearish, so you could take bearish positions. So with options, what's great about it is you can make money when the market goes up, make money when it goes down, but then also, make money in kind of sideways, consolidation areas as well, right? So options is much more than just buying calls or puts. You could become also an option seller. You can do things like credit spreads, debit spreads, iron condors. So you could take like iron condor type of strategies when markets are trading sideways. Take bullish strategies. You could either do naked options as an options buyer, debit spreads. You can sell credit spreads. And again, kind of flip it on the other side. You can take bullish strategies when the market's going up and then reverse them on the way down and also capitalize when the market is trading sideways. But again, you got to put this together. You have to know your proper, support, resistance, levels, the technicals, find those overall trends, and then put the trading strategy behind it, right? If you only are, again, just limited to just bullish or bearish strategies, you can miss lots of capital. You can miss, capitalizing on the markets or, with other types of trading strategies. So again, we're huge fans of trading options. We teach this in our community because again, it allows you the ability to make money in all different markets. So again, with bear trap trading, it's basically, a stock that's kind of moving up. Bears look and see and they think it's going to be a reversal. Price ends up falling back down, but then what happens is the bulls come in, reverse it, and a lot of times catches those the bears to end up kind of covering their position, which causes that squeeze, and many times it'll break out and continue up and continue that uptrend. So hopefully this video on bear trap trading helped you, and we'll see you in our community. Enjoy.